Hey everyone, Suzy here from Adventurous Real Estate Investors. Today is part 2 of our asset management series. If you had missed part 1, I'm gonna let you know that this series came because Michael and I did a presentation for the Real Estate Rocks Summit by Angel Williams, and we just had so much fun, and the value that we gave, we just got a lot of great feedback, and so we wanted to share it with all of you. But what are we going to talk about today, right? Like, what is part 2 of this asset management series? So we're going to talk about 4 things today. The first one is why slow is smooth and smooth is fast. We're going to talk about property performance, about property financials, or just financials as a whole, and then why it's super important and different ways to increase the NOI. But before I leave you today with our fantastic series, we are at the Shrubboro Estate, and here we are in their flower garden, and we just love it so much. We're glad that we can finally get out and explore again. So if you like this comment, please make sure to smash that button and then ring that bell so that you can receive more content from us. Cheers.
Absolutely. So as you take over the property, right? There's a lot happening, right? You have to worry about renewals, as Suzy mentioned. You have to worry about all these other things. The residents are not cooperating sometimes, and you gotta figure out how to get a riffraff out, right? So like during that whole process, it's very hectic. It's very, especially when you're changing new property manager on the property, right? It's gonna take 3, 6 to 9 months to actually get everything stabilized, get the income, get the expenses stabilized, and things like that with the new property management company. During that time, it's going to be very stressful for the regional manager and the on-site manager, right? They're worrying about the residents. They're worrying about making sure that they're getting things leased at performance rents. They're worrying about, making sure all the paperwork and everything like that is correct. So during that process, what you don't want to do is burden them with a crap ton of projects, right? A lot of projects. Like, you don't want to say, okay, well, we have to fix the fence, we have to fix the gutters, we have to fix the parking lot, we have to fix this rotting wood. Like, you don't throw all of that on them at once, right? So something that I learned in the military was this phrase, and it comes from the special ops community. It is slow is smooth and smooth is fast. Meaning that if you try to do 12 different projects all at once, it's just going to cause chaos. Yeah. Everything's going to probably fall apart, and those projects are going to end up being delayed even further. However, if you start off with something small and then you add one project, so let's do the fence this month, let's do the parking lot the next month, let's do the gutters the next month, something like that, right? Like, as you move through and you kind of plan it all out, you adding things on subsequently, but not trying to overburden the property manager, everything's going to go a lot smoother and the projects are going to get done a lot faster.
Yeah, and so then when you're doing these projects, it's like, okay, well, how do we evaluate where we're at? How do we keep track of everything while these projects are going on? Because there is just so much to keep track of, right? So the property management company has that business plan, but then what? What do they do? And so what we do to track the performance is that we have key performance indicators, also known as KPIs. And here are the 5 main categories that we track. So the first one is, I'm going to say it wrong. Lazel. I want to say Lazel. And we got that from Neil Bawa. But what it is that L is for leads, A is for appointments, S is for showings, A again is for applications, and L is for leases. And so you want to know, are the leads turning into appointments? Are the appointments turning into showings? Are the showings turning into applications? And are the applications showing into leases? Because leases are what make your occupancy higher, and that's what you want. That's how you achieve those pro forma rents. And the point of seeing all of them on the your KPI tracker is because you want to figure out if you have any bottlenecks in that process, because if you do, you want to get them fixed as soon as possible, and just coming up with creative and new ideas for the property management team to excel in all 5 of those places. So the next KPI category that we track is income. So within income, we track rent collections, net operating income, the amount that is delinquent, the number of residents that are delinquent, and then the other income collected. And we specifically do the amount delinquent and the number of residents delinquent because we want to keep track of that. But then what touch points our property management company is having with those individuals. And that's really key as well. Mm-hmm. So the third category that we look at is occupancy. And what is under occupancy is physical occupancy, leased occupancy, the number of month-to-month residents, and then the number of notices to vacate for 30 and 60 days. And again, that just gives you a pulse on like who could potentially be leaving and what will that do to our property if a lot of people leave at once, because again, you want that leased occupancy to continue to go up and you want the physical occupancy to also stay high. So the fourth category is maintenance. So under maintenance, we do open work orders, completed work orders that week, the number of vacant units or apartments, the number of apartments that are rent ready, and then the number of apartments needing make ready and renovations. And part of that is that we want to know, again, if there's a bottleneck or if there's any consistencies with the work orders so that we can come up with a plan to either make the process a little bit faster or to see if we need to be more proactive than reactive, right? So for an example of that, say a lot of people are starting to have their air conditioning units go out. It would be much more proactive than to have somebody go and check the units so that when you have another hot week, you don't have 5 air conditioning units that all go out in the same week. So it's just trying to find ways of being proactive. But then for the units, you also want to know what needs to be ready or how many need to be ready and how long it could potentially take. Because if you have a very good system where you have those applications turning into leases, you want to make sure that the units that need to be make ready are not just sitting there unturned. And then the fifth and final category that we look at is the loss to lease. And so that is really the difference between the leased rent and market rent. And so we track the average of the leased rent compared to pro forma rents, and that'll measure the loss to lease burn off. And it's just because while you have all of this going on, part of you is going to be like, okay, are we actually achieving the pro forma rents that we put in our underwriting? But if you're not tracking, what that average is to be able to compare the delta, you don't really know. You tell your investors, hey, this is what I think we can achieve, but how far are you off of it along the way? And I know this is a lot, but they're really important key performance indicators to track.
Yeah, that's a great summary of the categories that we track, Suzy. What I want to add is it doesn't have to be a very complicated, elaborate system for KPIs and how you track them. What we do is just use a Google Sheet, right? So we have a Google folder set up that we share. We'll talk about our tools at the end here, but we set up a Google folder that we share with our property management company, and they can go into there and look, and they can go into the Google Sheet, which then has our Monday reporting KPIs in there. And every single week they go in there, they update all of these line items. Yeah,
but and that also really helps them because then they can see it for themselves as well, so that they can identify their bottlenecks. It keeps them accountable, and then it also keeps us accountable with our business plan.
Yeah, we track these week to week, by the way.
Yeah.
All right. So here is a huge piece of being an asset manager and one of the most painstaking things of being an asset manager. However, it does play to my strength of having really good attention to detail. So I love reviewing the financials. It's a love-hate relationship, right? It takes forever, but it is so important. And this is going to make or break your deal. This is super important. So what we look for in our monthly financials is we get this report, the 15th of every month. So if it comes on the 15th, it's for the month prior. And so what I look at is I review all the income that has come in. I look at, and that includes, rental income and other income and things like that. I also look at the expenses, right? And I look, okay, is anything out of line? Is the maintenance and make ready, is that too much? Are we paying too much on lawn care services? Things like that. Just looking at those, make sure there's no crazy swings from the previous month to the current month, or looking at the trends over time, right? And then the big thing is I look at CapEx coding. Okay, what's coded above the line, meaning that's included in the calculation for the NOI? or what's included below the line, meaning that it's not included in the calculation for the net operating income, because that's, the things that you're replacing. So it'll all depend on what deal you're doing, the specifics of your deal. But a lot of times what I look at is whether or not that item that you did, the CapEx item, if that's a repair or if it's a replacement, right? And it gets coded differently for tax purposes and things like that too, because like through and around a CPA or anything like that. But if you're buying new appliances and like that, it could be replacements, could be going to CapEx, and then it could be a tax benefit as well. But check with your CPA; they can tell you more about that for sure. But just going through everything and moving things below or above the line as necessary in order to get a really accurate picture of how this property is operating. The other thing you need to be very careful and very diligent with is reviewing your general ledger. So this is every single line item, every single charge, and looking at all the invoices that you have from your property management company, making sure that they match up. Sometimes we've gotten invoices, and it's just from me reviewing the general ledger. I'm like, oh, that's different. That's like $50 different than what our invoice is. And it happened to just be a typo of transferring it, right? So like $50 doesn't seem like a lot of money, but hey, $50 10 times, then it's 500, right? And then over the life of a deal, over 5 years, that keeps happening, that you've lost thousands and thousands of dollars potentially, right? Or it's miscoded or something like that. So be very diligent and pay close attention to invoices and how they are reflected on the general ledger. Also, what we do every single month, and this takes a lot of time, however, it is very worth it, especially when you're trying to stabilize a property, is we look at every single line item in the general ledger. That's going to have, if it's an interior renovation, it's going to have a unit number attached to that. Now, what we've done is we've built a Excel spreadsheet or a Google sheet that everybody can see, all of our general partners can see. And I have the unit number listed on the left-hand side. And then I put in these line items for each unit. So if there's like new carpet, new flooring, new cabinets, things like that for that unit, and then I put a price, right? And for every single month, and I have months, and how much it costs and stuff like that. And so now I can get a very good picture from month to month, how much we're spending on unit turns and how much we're spending on renovations for those specific units. Yes, this seems like it's going to take a lot of work and it's very painstaking, but I guarantee you it's worth it, because then you know exactly how much you're spending and if you need to dial it back or you crank it up or something like that. The other thing we do with that, with our monthly financials, I also have a Google spreadsheet again, where I have our projected underwriting for year 1 or year 2 or year 3, whatever, and then break that down into month to month, right? So what you're trying to achieve from month to month, and then it equals what your year-end totals are, right? Your projected underwriting. Next to each one of those columns per month, then I put in the income and expenses, and then I look at the differences between the two, and that's the variances, right? So and then those variances we use to report to our investors, right? So, and it also gives us, the general partners and the asset managers, a great indication of how well the property is performing based on our projections, and whether or not we need to ramp things up and maybe look for other ways to bump some income and things like that. So the investors really love that, because it gives them a clear picture of how the property is performing based on what your projections are.
No, thank you so much for all of that, Michael. And something that he touched on was ways to bump income. And so that is what I'm going to transition into next. So what I want to talk about is like I said, ways to increase the net operating income. So here are some of the very traditional ways, and these are the things that you will see the most. So it's application fees, late fees, pet rent fees, early termination fees, and month-to-month fees. So right there, that's 5. And the list could go on. I could probably name another 5 or 10. That is a lot of fees on top of these individuals' rent. And so how do we create more revenue and happier residents? So many operators are adding more fees, but how do we think beyond those traditional fees? Like, how do we create a space where people or families are living in these assets and feel like they are actually people and not a paycheck? And what we came up with or found also was untraditional ways to add the net to the income. And so some of those are Amazon lockers. So Amazon will pay you to have lockers on the property. They aren't necessarily for the residents. They will just use so that the community around them can have access to closer lockers. So becoming a Tesla charging partner, again, you can apply for Tesla to just put a charging station or two on your property. So if your property is in a high trafficked area, like they will more than likely get traffic to that charging station and Tesla will pay you. So speaking also of high trafficked areas, if you are on a corner or if you're on a really busy street, you can add your own billboards and offer advertising. Like businesses around your community, if they know that you're getting a ton of traffic past it, then why not? I mean, putting that sign up will not cost very much, but I'm sure you can get very great premiums on that little rental space. Another great option is solar panels. Yes, I know this is an investment to begin with, but think about all of, like, if you're in a super sunny state, think of all of the money that you can get then towards the property because the electricity will pay for itself, how that will then benefit the residents. And then when you have that extra, how it will benefit the city. So that's like 3 wins within itself. And yes, the initial investment might be pricey, but you already have 3 wins immediately after, which is amazing. And then something else that we have been looking for, because it's just done really good things for our property, is green initiatives that are offered by your city or state. And so I have an example on the screen, and this is for LED lighting on our property. So just to break it down a little bit, we had the project cost was $9,158. The rebates that we got for these green initiatives was $8,730. So that means our total project cost was $428. That is phenomenal, where we were going to have to pay over $9,000 for LED lights. And because of the rebates that the city offered, we only paid $425. And the rebates, we got so many rebates because this is a direct benefit to the families living on the property because their electric bill will now be much less. And that was just a no-brainer for us. And what I have found is that a lot of cities actually will offer webinars. Like I have joined a lot of like the city newsletters and a lot of the newsletters for just like Tulsa landlords. And you have a lot of energy efficient companies who will come on and say like, we can offer you this, like, let us know before you're doing work and we can come out and see how we can help you save. Like it blows my mind how much money you can save on a property just by it being a green initiative.
Yeah, it's a great point about the green initiative, Suzy. And I want to point out as well, like in this little picture that we showed you here, like a total annual savings of $4,000. Yes, that is a projection, and we won't know what it actually shakes out to be until all these lights go in and then we actually do a calculation. But if we did save $4,000, right, and that decreases our expenses by $4,000, with looking at a 6 cap, this property is traded at 6 cap. That is an addition of over $67,000 to the value of the property. So this thing here cost us $428, right? And it added $68,000 to the value of the property. Incredible, right?
No, it is. Thank you.
So we hope that you enjoy of this series, but stay tuned because if you watch all 3 parts, at the very last one, comment in the comment section, #AREI bonus, and we'll send you the webinar slide so that you can check out all of the goodness in a packed full section.